Picture this. You are deep inside a high-security bunker underneath the Louvre in Paris.
Which, sounds like the start of a heist movie.
Right.
Yeah.
But it's actually the setting for the annual general meeting of LVMH, the largest luxury conglomerate on the planet.
Oh, to be a fly on that highly secured wall.
Seriously. So at the center of the room stands CEO Bernard Arnault. And he rolls up his sleeve to proudly show off his new Louis Vuitton Tambour Einstein Automata watch.
Ah, the Einstein watch.
Yeah, he presses a little button on the side, and a tiny mechanical Albert Einstein literally sticks his tongue out on the watch face.
And the whole room of shareholders just politely smiles.
Exactly. But outside of that fortified bunker, the reality is entirely different. The company's shares have plummeted 26% from their peak.
Wiping out billions in market value, yeah.
Billions. And the French media is just swirling with rumors of this brutal, real-life succession-style war among his 5 children for control of the empire.
I mean, it serves as a hauntingly perfect metaphor for the entire luxury industry right now.
How so?
Well, you have this meticulous, hyper-controlled, mechanical precision functioning on the inside, right? Yeah. Executives pulling levers, launching $100,000 watches.
Well, everything outside is on fire.
Exactly. The macroeconomic reality on the outside is bordering on total chaos. The illusion of control is shattering.
Welcome to More Taste Than Money. I'm your host, and this is our deep dive into the business of fashion. Today, our mission is to explore the massive fundamental rewiring currently happening across the global luxury and beauty business.
And we have poured through a massive stack of financial reports, market analyses, and insider coverage for this one.
Yeah, we're talking sources from the business of fashion, WWD, CNBC, and Bloomberg, all to understand what happens when an unstoppable business model finally hits a wall.
Right, because we are going to synthesize all of those sources to understand not just the staggering revenue drops, but the actual mechanics of why the foundation of the luxury market is shifting under our feet.
Because the math that sustained these conglomerates for the last decade is breaking down. So if you've been walking past storefronts recently, wondering why designer handbags have suddenly become impossibly expensive,
or if you're just trying to read the economic tea leaves of global consumer spending, basically.
Yeah, this deep dive is your shortcut to understanding the brutal, high-stakes business behind the bling.
Let's get into it.
So before we can unpack how individual fashion houses are fighting for your wallet, we have to look at the massive macroeconomic storm hitting the entire sector.
Because it's bad.
It is. We are transitioning violently from that wild revenge spending boom we saw in 2022 straight into a period of extreme volatility.
Right. And to understand the current slump, we really have to dissect what fueled that boom in the first place.
The pandemic savings, right?
Exactly. Following the pandemic, consumers emerged with built-up savings and this massive psychological desire to just treat themselves.
Treat yourself culture was at an all-time high.
It really was. And the luxury brands saw this surge in demand, and instead of just selling more items, they responded by hiking their prices aggressively.
I mean, we're talking about basic leather bags jumping 30 to 50% in price over just a couple of years.
Which is insane, and in doing so, they completely alienated their aspirational shoppers.
Yeah, think about the person who might save up for 6 months to buy a single pair of designer shoes or a belt.
Suddenly, the goalposts moved. Those entry-level items were pushed entirely out of reach.
And now the bill has come due because global demand is softening across the board. Like, we are seeing the sharpest pullback in China.
Which has traditionally been the undisputed engine of luxury growth for, a decade.
Right, but they are dealing with a lingering property crisis that completely changes the consumer psychology over there.
Yeah, the property crisis in China is a perfect example of the wealth effect in action.
Break that down for us.
So, it isn't necessarily that the upper middle-class consumer in Shanghai has suddenly lost their salary. It's that an enormous portion of their net worth is tied up in real estate.
Ah, so when the value of the apartment plummets.
Their paper wealth vanishes. The psychological safety net that gives you permission to walk into a boutique and drop $3,000 on a handbag evaporates instantly.
Even if you still have the actual cash in the bank.
Exactly. You just don't feel rich anymore.
That makes total sense. And if we look at the global map, we have to factor in the Middle East as well.
Absolutely.
Now, I want to make it super clear to the listener that we are strictly reporting on the financial data from our sources here without endorsing any political viewpoints or taking sides on the conflict. We're just looking at the economic reality.
Right. The impartial business reality is that when a region that drives 5 to 6% of global luxury sales faces severe geopolitical disruption. The economic ripple effects are massive.
I mean, Bernard Arnault himself warned shareholders that the ongoing conflict risks becoming a wider global catastrophe for the economy.
And we are seeing the numbers. Our sources cite a 30 to 50% drop in sales at major shopping hubs, like the Mall of the Emirates.
Wow.
Yeah, and LVMH's chief financial officer even noted that demand deterioration hit up to 70% in some malls during the month of March.
70%, that's staggering.
It's a cliff. When you combine that cratering of tourist and local spending in the Middle East with the wealth effect pullback in China.
And the price exhaustion in the U.S.?
Right, the whole foundation gets very, very shaky.
I look at the luxury market right now like a world-famous exclusive nightclub.
Okay, I like this.
So the VIP section, which is the Middle East, has suddenly emptied out due to all this uncertainty. So the club management is suddenly relying entirely on the regulars out on the dance floor.
The U.S. and China.
Exactly. But those regulars are already exhausted and, frankly, a bit broke from partying way too hard and paying cover charges that doubled over the last 3 years.
That is a brutally accurate analogy.
So here's the multi-billion-dollar question for you. If the macro environment is so hostile for everyone right now, how do we distinguish between a temporary, cyclical downturn?
Like where people just waiting for the vibe to improve.
Yeah, exactly. Versus a permanent structural rejection of these massive price hikes.
That is the big question.
Yeah.
Because, look, a cyclical downturn is simply a waiting game. People still want the product. They just want interest rates to drop or their stock portfolio to recover first.
Right.
But a permanent rejection is much more dangerous. It means the brand has fundamentally locked its perceived value. If a consumer looks at a $3,000 handbag and no longer believes that the craftsmanship, the heritage, or the social status it provides actually justifies that price tag.
The spell is broken.
Exactly. You can't put that genie back in the bottle. And that structural crisis is exactly what the big conglomerates are terrified of right now.
Well, if the entire market is pushing back against these price hikes, you would assume that conglomerates are scaling back.
You would think.
But when we look at the biggest player in the room, LVMH, we see a company that relies entirely on infinite scale. And those macroeconomic headwinds are exposing some serious cracks in that strategy.
It really is. It's bringing a lot of boardroom and family drama right into the public eye.
Tell me about it.
The numbers from their recent earnings report reveal a fascinating stress test of their model. LVMH missed expectations, reporting only 1% organic growth in the first quarter.
Wait, before we go further, let's clarify what organic growth actually measures for the listener, because it's a critical metric.
Sure, so organic growth strips out currency fluctuations and any recent brand acquisitions.
So it's like the purest look at the core business.
Exactly. It tells you whether a company's core of existing brands are actually selling more products to real people, or if the overall revenue numbers are just being artificially propped up by them buying new companies.
Got it. So when organic growth drops to 1%.
It means the core engine is stalling. And for a company that trained Wall Street to expect double-digit growth every single quarter, that is a jarring reality check.
And the timing of this stall couldn't be more dramatic. I mean, Arnault is 77 years old.
Right.
He insists he is staying at the helm for 7 or 8 more years, but a brutal, heavily researched 3-part investigative series just dropped in the French magazine Le Nouvel Obs.
Oh, it's a wild read.
They literally dubbed it LVMH's succession war.
Because the optics surrounding this are incredibly delicate right now. At that same annual general meeting under the Louvre we talked about, Arnault brought out all 5 of his children.
Delphine, Antoine, Alexandra, Frédéric, and Jean.
Right, all of them to speak to the shareholders. It was this highly choreographed, coordinated effort to present a unified front to a jittery market.
It honestly reminds me of a monarch trying to quell a peasant rebellion by parading the royal family out on the balcony to wave.
Yes.
You know, you are projecting stability, but everyone can see the sweat.
Oh, absolutely.
But then it gets so much messier. Arnault's wife, Hélène Mercier-Arnault, attempted this massive PR tour to soften the family's image, and it completely backfired.
It is a disaster.
She goes on French media, complains about high taxes, claims she stays grounded by sleeping in 3-star hotels.
Which nobody believes.
Nobody believes that. And then she showed a doctored, photoshopped family portrait on French TV to prove how close the siblings all are.
It turned out to be cut together from older pictures.
Which is so embarrassing.
And it's the absolute antithesis of what luxury is supposed to represent.
What do you mean?
Well, luxury is built on authenticity, Meticulous curation and absolute perfection. You are selling the idea of a flawless, elevated existence.
Right.
A hastily photoshopped family picture broadcast on national television is a messy, unforced error that completely shatters the illusion.
And despite all this internal drama and stalling growth, Louis Vuitton is still pushing for monumental scale. Like, they just built a staggering boat-shaped flagship store in Shanghai.
Oh, I saw that.
It is drawing 100,000 visitors a single week.
That's theme park numbers.
So let me challenge you on this. Is LVMH's current stock slump really about investor panic over who takes the throne? Or is it that their core business model, just buying up 75-plus brands and scaling them to infinity, has finally hit a mathematical ceiling?
I think it's the latter. The succession drama makes for great headlines, but the core issue is the math.
Okay.
Luxury fundamentally relies on exclusivity. When you build a retail store that processes 100,000 people a week, you are operating at the scale of Disneyland, not a luxury boutique.
Right, you lose the magic.
The financial markets are finally questioning whether you can maintain the aura of rarity when your products are that ubiquitous. LVMH has brilliantly defied gravity for decades by balancing massive volume with exorbitant prices.
But the gravity's catching up.
Exactly. The current economic climate is forcing investors to realize that you cannot be universally available and highly exclusive at the same time.
Well, if scaling to infinity is hurting LVMH, you would think that stripping a conglomerate down and focusing on fixing one core brand would be the answer.
You'd think so, yeah.
But when we look at LVMH's biggest rival, Kering, we see a totally different kind of trap. They show us exactly what happens when a conglomerate relies way too heavily on one massive brand that suddenly loses its cool factor.
Yeah, Kering's in a deeply vulnerable position right now. They reported a 6% revenue drop for the entire group, heavily dragged down by an 8% organic sales drop at Gucci.
Wow.
And we have to emphasize, this isn't a minor blip. This is Gucci's 11th straight quarter of decline.
11 quarters. That is nearly 3 years of shrinking.
Yeah. Enter their new CEO, Luca De Meo.
Right. He was recruited from the auto industry. He used to run Renault.
And he just unveiled his massive turnaround strategy in Florence, which they're calling reconquering.
Okay, that branding is a bit much.
It's a bit heavy-handed, yeah. But De Meo's presentation was incredibly blunt about Gucci's past missteps. He stood up and admitted that Gucci had treated the highly discerning Chinese consumer base like a, quote, trash bin for easy growth.
Whoa! That is a staggering quote for a CEO to drop about his own company's legacy.
I know, right?
What does it actually mean in practice, though?
It means acknowledging that during their massive boom a few years ago, Gucci was relying on fast trends, maximalist logos, and hype to drive quick sales, rather than building lasting brand equity.
So they were chasing the moment.
They were targeting younger buyers with disposable income but absolutely no brand loyalty. When the trend died and the logo fatigue set in, they had no solid foundation of classic timeless products to fall back on.
So what's his plan to fix it?
De Meo stated that going forward, Gucci needs to be unmistakable. As he put it, Gucci is not vanilla ice cream, it is spicy.
Spicy. Okay. But making a brand spicy again requires some ruthless cuts, right?
Yeah. Massive cuts. He is closing 100 stores, reducing overall selling space by 20%, and completely putting the brakes on acquiring the brand Valentino.
Wow. But the most radical part of his plan comes straight from his car guy background, and this is where I get really skeptical.
We were referring to the manufacturing overhaul.
Yeah. I mean, currently, 80% of Kering's manufacturing is based in Italy, spread out across various independent suppliers.
Right, and De Meo wants to pool that manufacturing. He envisions a shared ecosystem that covers 70% of the supply chain across Kering's different brands.
And keeping only 30% of the supply chain brand-specific to maintain differentiation.
Exactly.
Okay, let me push back hard on this. In the auto world, that means building an Audi A3 and a Volkswagen Golf on the exact same chassis to save money on parts.
Right.
You can't build a $4,000 luxury handbag on an assembly line like a Honda Civic. Doesn't centralizing manufacturing absolutely kill the magic? If I'm spending that much money, I don't want to know my bag was assembled on the same corporate supply line as a cheaper brand.
Okay, from a purely operational standpoint, De Meo would argue that you are romanticizing the supply chain. Sharing logistics software, consolidating leather procurement, or using the same shipping networks doesn't mean the final stitching isn't done by an artisan. The back-end consolidation is just math to save margins.
I don't know.
And this is a big, but Your reaction is the exact risk he is running. Luxury is an emotional purchase, not a rational one.
Exactly. I mean, it's like finding out the magician's assistant is just hiding in a trapdoor. You are paying for the romance, the idea of a lone artisan in a sunlit Tuscan workshop.
And if the customer starts to feel like they're just buying a product off a shared corporate assembly line, that premium pricing power evaporates instantly.
Poof. Gone.
DeMeo has to achieve corporate efficiency in the background without destroying the brand's mystique in the foreground. It is an incredibly difficult needle to thread.
Well, if LVMH's megascale is failing and Kering's corporate consolidation is risking their mystique, what about the brand that strictly limits supply?
Ah, yes.
We have to look at Hermes. They are the absolute gold standard of scarcity. You famously cannot just walk in and buy a Birkin bag.
No, you definitely cannot.
But even they are showing signs of gravity, which forces us to ask what actually is working in the luxury sector right now.
Hermes is usually treated as the impenetrable fortress of the luxury world. But in the first quarter, they reported 5.6% growth.
Which missed the 7% analyst estimate.
Exactly.
But wait, most businesses would kill for almost 6% growth. Why did the market react so violently to a slight miss?
Because of how luxury stock valuations work. That slight deceleration caused Hermes shares to suffer a record plunge of over 8% in a single day.
A massive reality check.
Right, you have to understand the concept of being priced for perfection. Hermes stock had recently been trading a Ferrari-like valuation,
Yes.
meaning investors weren't just paying for the bags being sold today. They were paying a massive premium based on the assumption that Hermes would deliver double-digit growth forever.
Oh, I see.
When growth came in merely good instead of perfect, that mathematical assumption violently corrected.
There is an incredible piece of analysis we pulled from our sources by Luca Solca, a top luxury analyst.
Yeah, that was fascinating.
He looks at this slight deceleration and compares it to Louis Vuitton's Capucine moment back in the early 2010s. Walk us through the psychology of that moment.
The Capucine moment refers to a specific dangerous phase in a mega brand's life cycle. In the early 2010s, Louis Vuitton's monogram canvas bags were everywhere.
You couldn't escape them?
Aspirational shoppers had saved up and bought them, which meant the ultra-wealthy suddenly started looking elsewhere because the brand was no longer exclusive.
Right. If everyone on the subway has the same logo, it loses its social signaling power.
Exactly. To fix this, Vuitton had to rapidly stretch upwards, launching the ultra-expensive, logo-free Capucine leather bag to re-establish their prestige at the very top of the market.
And Solca is suggesting Hermes might be hitting a similar ceiling of familiarity?
Yeah, exactly.
Leaving Hermes.
Yes. They have expanded their footprint so much that they may be reaching a point where they have to work even harder to maintain that peak desirability among the ultra-wealthy.
That is wild. Meanwhile, as the giants sweat, the quiet luxury sector is booming.
It really is.
You look at a brand like Brunello Cucinelli, they just surged with a 14% revenue jump, heavily lifted by the U.S. market.
Massive numbers.
And Richemont, the conglomerate that owns Cartier, is being shielded from the wider downturn by the stellar performance of their hard luxury jewelry brands, like Cartier and Van Cleef and Arpels.
This represents a fascinating shift in consumer psychology. In times of economic uncertainty, flashy logos feel tone-deaf or even socially risky.
Yeah, nobody wants to look out of touch.
Exactly. Consumers flock to understated, disciplined aesthetics. And with hard luxury, like jewelry and heritage watches, there is a perceived investment value.
Oh, absolutely.
A solid gold Cartier bracelet feels like a safer, more permanent place to park your money than a trendy leather handbag that might look painfully out of style in 24 months.
Let's use an analogy here. Think of Hermes like a world-famous, highly exclusive restaurant that is always fully booked.
Okay.
If they suddenly start offering takeout on a delivery app to grow their quarterly revenue, they completely lose their prestige.
Right.
But if they just keep raising the menu prices for the exact same steak to satisfy their Wall Street investors, eventually even their billionaire regulars feel like they are being gouged.
That makes total sense.
So I have to ask you, if Hermes is the undisputed king of the scarcity model, and even they are missing their growth targets, does this mean the concept of scarcity as growth is fundamentally broken?
Honestly, it means that scarcity at scale is an oxymoron.
Wow.
You cannot be eternally scarce and universally available. The financial markets demand perpetual, compounding growth every single quarter. But true luxury demands limitation.
It's a paradox.
Hermes has managed this paradox longer and better than anyone in history, but eventually you simply run out of wealthy people to sell $10,000 bags to, or you raise the price so high that the core value proposition breaks.
So the math of infinite corporate growth fundamentally conflicts with the definition of exclusivity.
Exactly. Which brings us to the ultimate reckoning for this entire industry.
Let's hear it.
If we connect all these threads to the bigger picture, we are witnessing a fundamental rewiring of what luxury actually means to the consumer.
Okay.
For decades, the massive conglomerates told us that luxury was about giant flagship stores, celebrity ambassadors, and instantly recognizable logos.
Right.
But if LVMH, Kering, and even Hermes are struggling to maintain the illusion of exclusivity at a global industrialized scale, perhaps the true future of luxury will revert to something much older. We might see a return to hyper-niche, localized artisans creating genuinely bespoke items.
Oh, interesting.
The exact kind of independent, small-scale creators that the giant conglomerates simply cannot acquire and scale without destroying what makes them special in the first place.
That is a fascinating thought to mull over. The ultimate luxury might just be something Bernard Arnault can't buy.
Exactly.
Before we wrap up, we always like to carve out a specific recommendation from our research pile for you to explore on your own.
Our carve-outs.
Yes. For me, if you want to read real-life corporate drama that honestly rivals an HBO script, you have to track down that 3-part investigative series in La Nouvelle Obs about the LVMH succession war.
It is so good.
It is a fascinating, deeply researched look behind the velvet rope at how one of the world's most powerful families navigates power, media, and some very messy public relations. What do you have?
For my carve-out, I highly recommend keeping an eye on the hard luxury watch space. There's fantastic detail buried in our Business of Fashion source.
Oh, the Timothée Chalamet thing.
Yes. Actor Timothée Chalamet just took a minority investment and became a creative advisor for the historic Danish watchmaker, Urban Jurgensen.
That's so specific.
It perfectly proves our point about the ongoing consumer obsession with hard luxury heritage timepieces and the pivot toward quiet, hyper-niche craftsmanship over mass-market flash.
That's a great pull. Thank you so much for joining us on this deep dive into the business of fashion.
It's been fun.
Keep looking beneath the surface of the brands you see every day, and the next time you walk past a massive flagship store, ask yourself what it really takes to keep that illusion alive.
And remember that tiny mechanical Albert Einstein sticking his tongue out at the multi-billion-dollar chaos of the market.
See you next time.